This week on the Defiant Podcast, we speak with Mati Greenspan. Mati is a CEO and founder of Quantum Economics, a crypto research and advisory firm. Mati has had his finger on the market's pulse for a long time now, so he'll guide us through the turbulent times of the last few weeks. So what's driving the market now, and does Mati believe this rising rates environment is set to continue? Here we are with Mati Greenspan, founder and CEO of a crypto research and advisory firm, Quantum Economics. Mati, it's great to have you in the Defiant Podcast. Welcome.
Good to be here. Thanks for having me, Cami.
Of course. So super excited to talk all things markets with you. I know you keep a very close eye, and things have been so rocky lately that I think we're all looking for some guidance on what's going on. So, what are the main drivers of markets, both macro and specifically crypto right now?
Well, I believe that the first and foremost is the Federal Reserve and the global central banks. As we know, they've been printing a lot of unnecessary money during the pandemic, and at the moment they're busy taking that money back. The Federal Reserve, headed by Jerome Powell, or as we like to call him, J-Pow, have basically gone from being the biggest buyer of financial assets in the world. Of course, in order to buy, they basically print money out of nowhere, so they end up buying stuff like bonds and other financial assets. And they've gone from being the biggest in the market to being the biggest seller in the market pretty much overnight. And as you can imagine, that does a number on all kind of assets, especially risk assets like stocks and cryptocurrencies, of course, fall into that category. And that's basically what we're seeing now.
Right. And so I imagine that is what's driving the increased correlation between crypto and stocks. That's been a really interesting trend this year, how those correlations have spiked. Basically, you're saying all these actions by the Fed is hitting risk assets, and crypto is just kind of put inside of that basket. Is that right?
Well, the Fed drives the long term, I believe. But correlations between stocks and Bitcoin at the moment are at an all-time high, and that's basically the day-to-day correlation, meaning if the S&P 500 goes up by 3%, then Bitcoin goes up by 3%. And I believe that that's more an issue of trader psychology and also an increased participation by institutional players in the market. The more we see hedge funds involved in Bitcoin, and as we know, DeFi summer of 2021, all of the major players got into crypto in a big way. Their involvement means a greater correlation, because if they are, let's say, taking evasive actions in their portfolio or something like that, that means that they're going to be buying, selling cryptocurrencies along and in line with everything else in their portfolios.
Interesting. So do you expect this high correlation to remain high, given that if we expect institutional participation in crypto to increase, then that would mean that we'll continue to see crypto and stocks remain correlated?
Yeah, it's kind of funny, right? Because it was, Bitcoin was pitched to Wall Street investors as the uncorrelated asset, and the more they get involved, the more it becomes correlated. So, yes, I believe for the time being, the more we see their involvement, the more that correlation can continue to rise. However, I do believe that at some point, the volatility of Bitcoin, the more we reach full market penetration, will come down over time. So Bitcoin at the moment is seen as much more volatile, let's say, than most stocks, even though we've seen, the bear market has revealed a lot of very sudden drops in some of the brand name equities. However, Bitcoin is still, all in all, much more volatile than the rest. However, it is much less volatile than it used to be historically. So the more we see Bitcoin taking its place in the world as a global currency, we should be able to see less volatility overall. Eventually, and I don't know when this will happen, but I do believe that it'll be somewhat like the US dollar is today, where it is seen as the stable currency and everything moves in relation to Bitcoin.
It was ironic that investors got into Bitcoin expecting Bitcoin to be uncorrelated, but then because they got in, then it became correlated. But you were saying that long term, you expect you expect crypto to behave differently.
Yeah.
Is that right?
Yeah, I've always kind of felt this way. I mean, since I first heard about Bitcoin, that over time, the bigger the market cap and the more it takes its place as kind of a global currency, the volatility will taper off. And we have seen it tapering off somewhat. And I believe that eventually, and I don't know when, eventually it'll be somewhat like the US dollar is today, where kind of everything is measured in Bitcoin and everything moves in relation to it.
And speaking of volatility, ETH is at 60% from its all-time high. Bitcoin is at around like over 50% from its all-time high. And at some point last year, it was feeling like crypto had, gotten over these huge kind of run-ups and huge corrections. Like maybe it was maturing, but now it's looking like, it's like the same kind of crazy run-ups and drawdowns are still the norm. So, I mean, what will it take for crypto to just, really mature and stop having these insane cycles?
Yeah, so I mean, I suppose we have to kind of put a separation between Bitcoin and all the rest of the altcoins, because I mean the altcoins can be extremely volatile, and I believe that on some level they always will be. Ethereum is coming down in volatility, of course, but a new altcoin that is experimental should be volatile because it's extremely risky. But I think that it's really is a matter of time, that the more there's kind of these steady inflows and outflows, buying and selling activity. At the moment, I think that probably somebody with $1 billion can probably push the price of Bitcoin, rather easily. And even have quite a large impact. I think that the more we see those type of steady movements, and we are seeing it, right? If we look at some of the on-chain data, we can see that Bitcoin's average value that's sent during the course of a day is now reaching all-time highs. And I believe that the more that goes up, it's basically replacing the dollar in global trade. And as much as that happens, that will reduce the volatility overall, because then you won't have a situation where or the amount of money required in order to kind of push the price around goes up to a point where it's simply not feasible anymore.
Okay, makes sense. So at that point, then what will happen probably is that you will see cryptocurrencies themselves become less correlated. So maybe you'll have Bitcoin, Ethereum, maybe a couple others be the big kind of I don't know if you want to call them blue chips or whatever, but like the biggest market cap coins, which will be likely more stable or less volatile. And then you'll have kind of the more experimental cryptocurrencies and tokens that will be a lot more volatile, and maybe we'll see kind of those differences in market behaviors that right now all of crypto is pretty correlated, but I guess as the sector matures, that won't be the case anymore.
Well, I'm not so sure, actually, Cami. To tell you the truth, I mean, stocks are quite correlated across the board, and they always have been, as long as we've been in a kind of globalization mode in a global market. I mean, there isn't any real fundamental reason why, if stocks are going up in China, then they're more likely to go up in Europe, and then the United States comes in and for some reason does a flip-flop and erases the gains. I don't know. But they always have been like that, and it always has been that the world is kind of a moody place, and mood tends to affect the way that investors are buying and selling on any particular day, hour, or even down to the minute. So a specific news event can come out, and even though it probably shouldn't have any real impact on the price of stocks or commodities or currencies, it does. And what we're seeing now, and until now, crypto has been so small that it didn't really join that part of the market. It really didn't join that kind of frenzy of the global mood affecting what's happening on the ground or affecting prices, but rather it was just kind of it was playing catch up to the rest of the market. And now we're starting to catch up, and now that we have, it's probably easier to see it as a kind of migration. And even the pinned tweet that I have on my portfolio right now on Twitter is a quote that I gave CNBC back in 2019, which is that in the next 10 years, all stocks, all financial assets, anything with a value and that can be traded will trade as a token, and that includes Apple stock and Tesla and any other companies that might exist at the time. So will correlation between the different digital assets come down? I don't know. I don't think so, and I don't think that it necessarily has to or should.
As builders continue to innovate and adoption ramps up, Avalanche is striving to design the premier scaling solution for Web3. Avalanche subnets let you minimize transaction costs and maximize your speed, consistency, and user experience. Scale with Avalanche subnets and experience Web3 like never before. Head to avax.network to learn more. So what's Mati's background and what drove him to start Quantum Economics?
Yeah, so I was the senior market analyst at eToro for 7.5 years. I left in November of 2019, just a few months before the pandemic. People thought I was crazy going to work from home, but in the end it worked out quite well. We do a number of projects involved in research and advisory within the crypto space. Really, we help young projects grow in giving them advice, introductions, resources, support on social media if needed. And of course, we do a lot of groundbreaking research for some of our sponsor clients. Namely, Luno Global is one of our clients that sponsors regular research. Basically, we get together with them, figure out what do they want to know, what's tickling the back of their brain, what do their audience want to know, and then we get together. We have about 24 of the industry's most prolific writers on staff, and they basically do groundbreaking research, stuff that's in my mind quite newsworthy, where we come in and figure out a lot of the questions that you're asking, like the correlations between traditional markets, on-chain analysis. We do a lot of stuff about adoption in Africa because in our mind it's one of the most exciting places where we see technology leapfrogging traditional or the developed world actually, and we saw even just Uganda yesterday reversing course, which I thought was quite amazing. They were talking about banning cryptocurrencies, and all of a sudden now they're creating a sandbox for digital assets. The Central African Republic adopting Bitcoin as legal tender, and and we saw Nigeria's central bank also completely reversing course. I like to think that we had a hand in that as well with some of the research and outreach that we did at the time. These are some of the things that we're focused on. But we really stand ready to go anywhere. Each of the analysts on our team has a very specific focus in the market. So, when I got into Bitcoin in 2013, it was like, okay, here's Bitcoin. It's right between crude oil and gold on my watch list, right? And nowadays the industry has become so diverse that you really need dedicated people on each and every sector.
Okay, and do you do any investments via quantum economics?
I have actually, we're looking into a few options for money management and formation of funds, but of course those are always very time consuming and expensive. So a lot of different things that we're looking into, but nothing to announce at this time. I do have a active account on eToro, which is the firm that I used to represent, and doing not too bad actually. So anybody can come and see my performance and the cryptos that I'm holding in the eToro account. And people in the United States can even copy me, basically mirror my portfolio there. But I see staking and staking rewards as nothing short of the future of finance. I'm staking on a number of protocols, including some that I'm advising. So there's the Revolt network, which is an aggregator on the Binance Smart Chain, as well. Lunar Crush, who I'm advising, has recently implemented staking rewards right through their platform. They're giving 25% annually. I'm also staking on Near Protocol on several of their different options, and Supremacy Game, who I'm advising, is a really cool NFT robot fighting game that I advise, and they've recently introduced staking through their platform as well, which is pretty handy since I have a bunch of their tokens, and more than I could ever spend in the game. So it's nice to earn a nice extra percentage by providing liquidity. I believe it's a very sustainable model.
Nice. So lots of staking, it looks like. Are you also active on DeFi, kind of yield opportunities, yield farms, that sort of thing? Or do you prefer a more kind of, more passive sorts of strategies?
It's only a matter of time, I believe, until kind of decentralized finance takes the place of centralized finance. It's kind of understood that bonds in general, which is basically lending your money to the government, is a dead asset class. And you can do things much more efficiently and much more profitably, I believe, by having these kind of DeFi staking options and yield farming protocols. We're not quite there yet, but I believe that the transition is coming to where normal investors, and we're already starting to see it happen, are going to say, wait a second, why am I lending my money to the government and losing money, after we calculate for inflation, when I can go to, the DeFi market and actually earn a respectable yield by lending my money out to, a liquidity farm who's using the money and using it for a good purpose, and then I get a percentage of the commission or something like that. This is, in my mind, this is where we're headed.
DYDX, the Decentralized Derivatives Exchange, is on a mission to build the world's leading crypto trading platform. To further this mission, the team is now developing the next version of the protocol, V4. DYDX V4, launching at the end of 2022, will be open source, fully decentralized, and entirely controlled by the community. To help power this next step, the community has launched a grants program with funding allocated to open source builders, contributors, and ecosystem integrations. Come help build the future of decentralized trading at DYDX Grants. Crypto and traditional markets have become increasingly correlated this year. We speak about whether this trend is set to continue and what this means for investors' portfolios, considering crypto was supposed to be an uncorrelated asset class.
Yeah, well, I mean, we obviously can't really know the future, but as much as I understand and I can foresee, well, let's just say where we are right now, which is the current market and the current DeFi market is very aloof. It's very kind of up in the air, and there's very little kind of tying it down to the ground, which is why I believe Circle recently made headway with their Teller protocol, which actually offered a home loan and actually awarded a home loan to one of their users based on their credit score and stuff like that. And that's basically tying the real world, because DeFi is kind of as it stands, it's kind of people lending money around, but nothing actually tying it to real businesses. And the more we bridge that gap between new age finance and traditional finance, the more I believe we'll have this kind of use case. It's all very much kind of under construction at the moment, which is why I find it fascinating that DeFi summer even took place to begin with in 2021, where we saw so many institutional investors, VCs and whatnot, rushing towards DeFi, even though the use case is still very disconnected from the real economy. However, what we're seeing right now is the testing of new economic models, and a lot of them are going to fail. And especially now during the bear market, we're seeing a massive shakeout, where some of the ones that maybe didn't have the strongest fundamentals probably won't survive, or at least they'll survive in a very diminished state. Yeah, but it only takes one or two, that actually make it in a big way to essentially change the world.
Right. That's fair enough. I agree that right now DeFi seems very endemic.
Yeah, exactly. So I believe that over time, right now new economic models are being tested at the moment, and especially now in the bear market, we're seeing a lot of them fail, and that's kind of a natural process. It's easy to make money while the Fed is handing out money like it's candy. But if only one or two or three of these new models kind of end up making it and end up being sound, we can literally change the world, make it a more fair and equitable place for all human beings, and that prospect is certainly worth all of this experimentation in my mind.
And speaking of DeFi and the market right now, what about kind of the Luna collapse? Do you think that we have seen most of the repercussion of that kind of crash and implosion, or do you think we'll still continue to see the kind of ripple effects, and if so, like, where do you think those are?
Yeah, yes. To pointedly to answer your question, I believe that the repercussions are already behind us. However, more broadly, I would say that Luna is a symptom of the bear market, much more than the other way around. Luna could have continued, with free money flowing from the Fed. Luna could have continued for many more months, possibly even years, as long as there's new money coming in to feed the monster. It could have gone on forever. However, you can't continue to offer 20%, in a bear market. 20% is difficult in a bull market. It's possible, but difficult. And I've seen even banks offering 20% in bull markets past, when, before we saw such, manipulation of interest rates and stuff like that, 18%, 19% for a CD. I mean, that was reasonable, when I was growing up. In a bear market, it's simply unsustainable. And I don't believe that they managed it correctly, and that they didn't kind of start taking back that 20%, but rather it was that 20% was feeding the new users, and they ended up taking out from the treasury in order to sustain it. And I believe that was kind of one of the biggest one of their downfall mistakes, that when it came time to pay out of the treasury to continue the peg on UST, there was nothing left. So yeah, but what are the repercussions, right? This is the thing that really gets me is, Luna's market cap was about as big as Lehman Brothers, right? I mean, in Lehman Brothers, we know that was one of the big hallmarks of the 2008 financial crisis, that Lehman Brothers collapsed, and the government didn't deem them too big to fail, or hand them a bailout or anything like that. Lehman Brothers had a knock-on effect, which kind of, I believe, was a contagion, basically, and it affected many other markets as well. Whereas Luna, they sold off a bunch of Bitcoin that day, maybe over a 2 or 3 day span, but the selling of Bitcoin was pretty much over. The losses were pretty much, in my mind, contained to the people who had invested in Luna, which hopefully most of them kind of understood the risks that they were getting involved in. I'm certain that there were some people who weren't, but I believe that most of the people who invested in Luna, at least, were somewhat diversified in their portfolios. And I believe that also there were many billionaires involved that probably they took probably the brunt of the biggest losses. CZ, Sam Bankman-Fried, unfortunately for them, lost, as far as I understand, they lost billions on this. I believe that's behind us, but the bear market will continue for as long as the Fed keeps on tightening. And I think that, by the end of the week, we should be a bit smarter about inflation. We get some inflation data from the United States. As long as inflation is actually coming down, I believe the Fed can ease up on some of this pain that we're seeing right now. And they're the ones that control the dollar, and they basically control most of the money in the world. So they're really the ones who are causing this pain, and they're the ones who have the power, unfortunately, at least until we get off of that system and move on to something new. They're the ones who are kind of calling the shots at the moment.
Right. And do you believe that the rate hikes will continue as long as inflation isn't under control? Or do you think there's a point where the Fed like politically can't afford to continue raising rates even if inflation doesn't come down. I mean, does that kind of play a role as well? Like, I mean, will the Fed say, okay, it's been enough kind of bloodshed in the markets, like let's stop raising rates even if inflation doesn't come down? Or do you think like we'll need to see a better inflation print for rate hikes to stop?
Right. So as the old saying goes, the beatings will continue until morale improves. Right. At this point, so as we know, that the Fed has been under fire for insider trading, and Jerome Powell himself sold about $1 million worth of equities just before, before starting this rate hike, harsh rate hike regime. Now, obviously, central bankers are among the most ethical people in the world. Not, but so we can't really make any kind of direct correlation. However, if you're asking politically, and as far as Joe Biden is concerned, inflation is the killer, right? So that's the enemy that they need to get under control much more than the markets, because Biden can handle a market crash and get reelected. He can't handle 8% inflation and get reelected, and there's only so much he can do to blame Putin for this, because people kind of are smarter than that these days. So yeah, as far as the Fed's motivation is concerned, it's to get inflation under control at all costs. And yes, I believe that they will continue to beat the markets until that is under control.
Got it. Okay, so it will really have to wait and see for inflation prints to kind of for guidance on what where the market is going to be headed.
It sucks, right? But I mean, think about it. 6 months ago, Bitcoiners were all like, "Yay, inflation is high. Bitcoin's going to the moon." And now these days, they've changed their tune 180 degrees. Oh my gosh, inflation's high. What are we going to do? The Fed's going to continue to raise rates. It is a bit silly, but this is where we are.
Two of the most important things to consider during a bear market are secure infrastructure to hold your assets and high yield to earn passive income when charts are red. On Nexo, you can find both. Their user-friendly platform allows you to earn up to 16% on crypto and 12% on stablecoins. If you need quick access to the value of your crypto and even your NFTs, you can borrow against them at rates starting at 0%. Join over 4 million people and get a welcome bonus of up to $150 in Bitcoin until June 30 at nexo.io. A potentially huge positive is coming up for Ethereum, and that's the merge. This year's update to Proof of Stake has been touted for months, and some argue it should already be reflected on the price. We discuss whether that's the case and the impact the merge should have on the Ethereum ecosystem.
Yeah, so it's difficult to understand what the actual, the way things work in testnet is almost always not how they'll end up working, on once you put it on the live version. In my mind, there's a fear as far as the economics are concerned with reducing the fees too much. Now, first of all, we don't know how much the merge is going to actually affect fees. Certainly, lower fees are better for financial inclusion. They're better for onboarding more users. So there's probably more than half the planet right now who simply cannot use Ethereum because it's just way too expensive. So that'll help them on board. However, reducing the fees economically is not something that is prone to reducing the price of the asset, simply because the fees are the network's way of retaining value. So if you push something through Ethereum, through the Ethereum network, if you're pushing, $1,000 worth of value, and the fee is going to be $60 on that, the network is actually retaining that $60. If you're pushing $1,000 worth of value through Ethereum and the fee is only, 8 cents, how much is the network really retaining? So higher fees means more demand on the token, right? If you need $60 to pay for each transaction, you need more Ethereum in your wallet in order to process 10 transactions. It's just a fact of life, right? Whereas a lower fee means that you'll be able to process hundreds of transactions, with only $50 in your wallet. So the demand on the token will go down in my mind. However, there's a trade-off. Like I said, I mean, if we're onboarding, billions of users, that might keep things up. However, the fun thing about Ethereum is that, it's not like Bitcoin where the economics are set in stone. The Ethereum Foundation has before and will again tampered with the rate of issuance of Ethereum. So if they feel like there isn't enough demand on the Ethereum token, they can change that, right? They can just make sure that there's less Ethereum coming into the market, and bada bing, bada boom, problem solved. So that's kind of, I think, kind of the ace up their sleeve. But how the merge is going to affect the price of the token, I don't believe that the speculation that we're moving forward is really the strongest factor here.
Yeah, I mean, the merge itself isn't supposed to really impact fees, since it's just the consensus mechanism what's being changed, not really kind of like sharding isn't being included at this stage, or anything else that will help Ethereum scale, really. I think the impact in fees will be pretty marginal, as I understand. It's kind of the stuff that impacts the prices, like the burning mechanism and how inflation changes with the merge, but not really fees. So yeah, I think TBD. I think it's just really hard to say exactly how the merge will.
So maybe you tell me then. What do you think is gonna be the impact?
Yeah, no, I'm really not sure. I think I actually do think that the merge is priced in. I think it's kind of been a long time coming, and I think most kind of whales know about it. So whatever just like impact the news had has already been incorporated in the price. I think it'll be a non-event kind of price-wise, but nonetheless important for Ethereum to just like continue on its roadmap until it can actually scale. But yeah, the merge right now, I think the purpose is to make Ethereum more decentralized, like giving a greater number of people access to running a node. Instead of having to have all the infrastructure needed for proof of work, you just need to stake 32 ETH, or a fraction of that if you're going through different third parties. But anyways, I think it's
aggregate.
Yeah, kind of.
We'll have a website that you could just stake a quarter of an ETH in there, and they'll give you your portion of it.
Yeah.
I suppose that would might lock up more Ethereum into staking, and maybe take some of the supply offline. Be interesting. I was always under the impression that it was supposed to reduce fees, but if you're telling me that's not the case, I think that's like kind of what's the point, right? I mean, that's in my mind the biggest problem with Ethereum right now is the fees. That's what makes it prohibitive from people in developing economies from using it. Most people in Africa they have no, they know Bitcoin and they're using it, but they have nothing to do with Ethereum or any of these NFTs or DeFi. It's just too far from them.
Yeah,
it's
yeah. I
unattainable.
think that's the role of layer twos at sidechains at this point, more than kind of the like proof of stake mechanism. So the hope is that like connection, like bridges to layer twos, will be better and more usable, and Ethereum will be cheaper through those platforms. But like mainnet itself will continue to be really expensive to use.
It's the same argument that the Bitcoin maxis use. Is like, oh well, we need to rely on layer twos because the layer one is never meant to scale.
Yeah, it's pretty similar actually. I think the difference is that I guess like the difference is just like the level of computation that you can get on Ethereum versus Bitcoin is like continues to be better on Ethereum. But anyways, I think it's pretty similar actually. Yeah, it's like layer one is kind of the most secure layer, and then layer twos provide scalability.
Yeah, I've had that conversation with Adam Beck more than once. He really drives that point home, and it's funny now that you mentioned it as part of Ethereum, because I always thought that the point was to make Ethereum itself more scalable, but what you're telling me actually makes a lot of sense. It's like you can't make it much more scalable than it already is.
Yeah.
But you then need to rely on layer two solutions, which is happening.
Yeah.
Anyways.
Yeah, it's slowly happening. It's really kind of tough to use those layer twos, but it's getting better.
I was pretty happy with Polygon's integration on OpenSea. Honestly, that to me was like, you're able to make transactions with for fractions of a cent, and buy and sell NFTs anyways. But the different protocol, it's going to be up to the end protocol to make it user friendly, not user friendly.
Yeah.
It's going to be up to the end web and the developers that are touching the users at the end of the day to make sure that they're integrating those solutions properly.
Yeah, exactly. And maybe that's kind of the upside of bear markets, is that developers will be kind of heads down with no distractions, building those better, more usable protocols and apps.
Yeah, we can only hope, but though at this point the bear market is so severe that some developers are finding it tough to continue and fund operations, and that.
Yeah, that's
that can be difficult, but that's part of these cycles that we go through, and it's only the ones who are, I think, either the most well funded or the most committed that are going to be able to make gains during the bear market, and making gains during the bear market pay off exponentially in the bull run.
True. So right now, like if the bear market continues, which areas in crypto do you think are the most at risk? Like where do you see kind of companies or projects shutting down?
Oh boy, it's everywhere. It's gotten to be pretty severe at this point. I mean, people from the smallest projects, a lot of whom have already gone under. I've seen projects already, preparing their eulogies, so to speak, for the smaller ones. For the bigger ones, some of the exchanges are already laying off staff. So everybody is in kind of hunker down mode at the moment. I mean, there's no part of the market that's been spared from this. It's getting very difficult to make new deals. What we're seeing now is pretty brutal, and I do hope that this is the end of it. Honestly, dark the darkness before the light at the end of the tunnel.
Do you think is that the case because a lot of projects had their treasuries in volatile tokens, or is it also a matter of there's just less demand for whatever it is that they were selling, a combination of both? Like, where's the pain coming from?
Yeah, so certainly, and that's what we saw with Luna, was that they were holding their reserves in Bitcoin, which those were supposed to be holding up, and that's why Tether was fairly immune. I mean, there was a run on Tether. We had I actually spoke with Paulo Arduino while the Tether peg was was in question, and we saw Tether down at 95 cents, and he's like, "Look, we're holding U.S. dollar bonds. We're not dumb shits like Luna, who are holding Bitcoin, and now their purchasing power is down 50%. They're like, we're trying to peg to the U.S. dollar, therefore we need to hold dollar-denominated assets, which are liquid, and those are, unfortunately, they're mirroring the Fed and buying bonds. And now that people were selling Tether, they're actually mirroring the Fed again and selling bonds. But that's kind of where they need to be in order to remain stable. So certainly any projects that's holding their reserves in tokens and volatile tokens, they've been hit the hardest. However, for exchanges, for example, I mean, their volumes are down, right? Their volumes are way down. So that's their revenue, right? So if Coinbase was making ridiculous revenues when volumes were up in the air, we better hope that they were acting like squirrels at the time and kind of borrowing some of that money away for a rainy day, because that's the only way that they can survive the winter. It's a simple matter of hibernation. They need to then reduce costs, lay off staff, make sure that they're more efficient. The only part of the market that hasn't really been hit yet, or hasn't been hit hard, is Bitcoin miners, where we can see the hash rate somewhat staying stable. It's still extremely profitable to mine Bitcoins, even though there have been some level of selling of mining equipment. We've seen the prices on mining equipment going down lately because the price is going down. Maybe they're a bit less profitable than they were before. But anybody who's running on not even the latest models, but let's say the S17s, F17 pluses, as long as they're not paying silly retail energy rates, should still be profitable. And we're seeing mining activity, especially in West Texas, continue to expand. So we hope, and knock on wood, that doesn't get hit or completely obliterated. Though if it does, we'll be okay, and we'll be able to make gains during that as well.
Yeah, it's interesting. We have an article on the Defiant on how hash rate for Bitcoin and Ethereum are both new records. So I that was a surprising development, I guess. Why do you think hash rate has kind of remained high?
Because the ones who've gone offline are the ones who are paying retail rates for energy. So if their energy costs are very high, or B, are using older machines. So those are the only ones who have gone offline, but the bulk of the hash rate is coming from efficient miners who are running new machines at lower energy costs. So that's going to make up the vast majority of mining and hash power. So there has been some level of capitulation but only on on those two levels is the higher cost for electricity and the less efficient machines, which are a very small portion of the market.
Yeah, that was such a surprising kind of stat. And then wrapping up, do you have a target or a forecast for Bitcoin price by the end of the year?
I can say with a 99% certainty that Bitcoin will be between $100 and $1 million by the end of the year.
Okay. Okay, I see. All right. If not like a specific number, do you have like a general kind of trend?
I can tell you what I want to happen, Cami, which is that Bitcoin reduces its volatility, right? Finds a base level, something like we did in the bear market of 2018, right? We found that $5,000 per coin, right? That was the level, and it stayed there for several months. And then we saw that again in 2019, where it stayed at 10K. It just stayed there for several months. I think that if we can hold 30K until the end of the year, that would be incredibly healthy for Bitcoin. As much as we see less volatility and a more stable price, the more people can use it in day-to-day transactions and long-term contracts. And that's the key to adoption, is those long-term contracts, because right now nobody in their right mind is going to sign a contract that is in Bitcoin terms that's going to last more than a year, right? If you're building a building or you have a media partnership or anything like that, you know what your costs are going to be more or less, but you can't set a price in Bitcoin because it's just too volatile. The more we see the price of Bitcoin stabilizing, the more people are going to be able to use it as a basis for their calculations, and that in turn causes less volatility and more stabilization. And that's the key. That's what's good for Bitcoin. That's what helps Bitcoin grow.
So you do see Bitcoin becoming this exchange mechanism, like beyond digital gold, like something to have as a store of value. You see this as something that you can kind of buy coffee with.
Well, no, I don't think that we'll be able to buy coffee with Bitcoin per se. Certainly not on the layer one. It doesn't work like that. I mean, look, sometimes it works pretty quickly. I mean, you get a confirmation within 5-10 minutes, you're good. Sometimes even faster, and depending on which services you're using. But sometimes you send a Bitcoin transaction, and you're waiting 4 hours, and there's still no confirmation. So no, it doesn't work like that. And even if if it's only 40 cents per transaction or 50 cents per transaction, that's still way too much, for a $3-4 payment. So I don't believe that Bitcoin itself will be usable for a cup of coffee. However, I do believe that we'll get to the point where people can kind of run their businesses on Bitcoin. If you have, contractors who are willing to accept a flat Bitcoin rate, and you have clients who are willing to pay you in a flat Bitcoin rate, then you can kind of manage a business on it.
Got it. Perfect. All right, Mati, thank you so much for joining me and taking the time. This has been a really interesting discussion on the crazy markets that we're living in right now. So thanks so much for providing your insights and guidance.